Hi, good morning, everybody, and happy 2025. Very excited today. We've got a couple of interesting conversations. We're excited about 2025. And I just want to start by saying I wish you all, wherever you guys are, happy 2025. I hope it's a good year for everybody. I hope it's a good year for the markets, and I hope it's a good year that we can make returns for you. Today, we've got a relatively interesting session. We're already halfway through the 2020s. We are entering 2025. It's been an exciting it's been a exciting 5 years so far. We've seen markets being volatile. We've seen markets choppiness in the markets. We see interest rates go up. We see interest rates go down. But in the end of the day, in the last 5 years, it's been relatively good for equity markets. Been equity good for fixed income. Been generally good for investing overall. Today we've got an interesting session. We think there are a couple of things that you really want to focus on, and there are three I's that we're going to introduce in this presentation. We're going to talk about isolation, inflation, and income. And we believe that these three words will actually dictate a lot of the conversations that you're going to see over the next 12 months. We're going to get Jinier to talk a little bit about our opening remarks. Then we're going to get Tony. Tony's going to talk a little bit about our outlook and global Asian economies. And then Jinier, Tony, and we've got a guest speaker from Wellington today, Philip. Philip's the managing director for equity strategies with the Wellington Management Group. They will talk a little bit about the prospects about the Asian markets. We think Asia, it's at a very interesting point, and we think there's a lot of conversations points here. And to supplement that, we will have a Q&A session. At the end of this, basically, we get Jinier to talk a little bit about the summary of all the events, what we're looking at, and obviously, this is the start of the conversations that we're going to have with you the whole year today, and we're very excited to do this with you. So I'm going to pass it on to Jinier, and he will speak a little bit about his opening remarks. So Jinier is our CIO at UOB Asset Management. Jinier, good morning, and welcome to the conversation. Yeah.
Good morning, Shankar. And good morning to all. Thanks for dialing in for our first half 2025 outlook. I think as Shankar mentioned, the three I's of 2025. Isolationism, protectionism, and nationalism. Well, I suppose we all are quite familiar with Trump's Make America Great Again kind of policies. Trump's threat of tariff and probably counter tariff from the others may actually means deglobalization. And what does it mean for global economy? Unfortunately, it is probably going to be inflationary in many parts of the world. Inflation is moderating, but I'm afraid to say that it's probably going to be stickier and higher for longer. So maybe U.S. inflation may not fall back to the 2% target, and maybe it's around 2.5% and 3%. I think that could mean that Fed may not need to actually cut interest rate many more times in 2025. And leading to our third I, which is income, and I want to stress that we are talking about real income. After offsetting your stickier inflation, will continue to be an important part of your portfolio allocation to provide you, steady real income, and maybe some part of the fixed income market in Asia may likely to outperform going forward in the year in 2025. I think with that, I will pass it back to Tony to bring us through the outlook for global and Asian economies. Over to you, Tony.
Okay, thanks, Jinier. Good morning, everyone. So let me share some thoughts on just the global macro outlook. Let's see. So let's jump into it. So for the most part, I think it's fair to say that we have a pretty constructive, positive base case for 2025. We see the global economy is continuing to expand, and we think there are good investment opportunities in global equities and global fixed income. I would note that I think compared to, I think if for those of you who have joined us in the prior years in 2023 and 2024, we started those years with a pretty constructive, positive outlook as well. But what strikes me as different right now is that for the first part, I would say back in 23 and 24, I felt like our views weren't necessarily very consensus. I think a lot of other recommendations were a little bit more cautious over the last couple of years. Whereas right now, I would concede, as far as I can tell, pretty much all strategists that you might be talking to, most fund houses you must be talking to, they're probably articulating a similarly constructive, positive outlook for 2025. And then the other thing that really jumps out at me as we engage in our conversations with clients is that clients seem quite prepared and eager to invest in 2025. And that's different than the last couple of years. I think you all might recall that, in the last couple of years, things were, a bit more challenging after that tough year in 2022, and deposit rates had been good for the past couple of years, and therefore people were a little bit less eager to invest when you can get fairly decent deposit rates. Whereas right now, deposit rates have come down a bit. Markets have performed well the last couple of years. There's not really any sign that this global expansion is going to end anytime soon. And so I think we're investing in a world where pretty much everyone seems to be on the same page. And I think the challenge is this year that there are still several that we're monitoring, and I'll go through those. But for the most part, I think we're in a world where people will be hunting for ideas, and so hopefully through today we'll highlight many of the ideas that we're thinking about, and particularly in the Asia region, which I think hasn't been as much in focus in recent years as it should have been. So a couple other quick points. We think equities will have another good year, and we think fixed income yields are attractive, and we think provide a good base for income investors. We're expecting one to two more rate cuts in 2025. We think Treasury bond yield should be ranging between 4.25 and 4.75. I note that it's currently pushing that upper bound, but we can discuss that. We expect the US dollar to be sort of well supported and kind of trade at the top of its range, and that we think equities in Asia can outperform in the second half of 25. We're kind of suspicious the first half maybe has some volatility, but we're still kind of positive for the year for 2025. But we kind of want to get through this tariff period at the start of 25 before we, I guess, go in more strongly. So, as a macro team at UOB Asset Management, like many places, we look at all the various sort of drivers into markets. And I think, the way I would describe things is, for the most part, markets, both stock and bond markets, have a bias to perform positively in most years. But, we have to be mindful that, economies have cycles, and that there are various policies and geopolitical risks that can affect things along the way. And I'd say our main takeaway is that when it comes to the economic expansion, as sort of like the first check we see to make sure that the things are on track to have profitable returns, the economic expansion, I think, looks as sort of clear cut as it has for a while. I would say the odds of a couple more years of a global expansion look really high to me now. I think there were some doubts in recent years, can the economy withstand the higher interest rates? But I think we've really sort of answered many of the questions. And for the most part, at this part, we've gotten through the hard periods. Interest rates have come down a little bit, and therefore, if we were able to survive that, we should be able to have all the more confidence in the next couple of years. And additionally, the U.S. consumer remains a strong driver. China has some stabilization policies. Trump has sort of mixed policies, but in the end, we do think things like his tax cuts are going to be a fairly influential economic policy, and therefore we really come to a conclusion that we should expect things to continue. And then I'll discuss the risks in other slides, but for the most part, we're watching valuations. We think they're somewhat uncomfortably high, but we don't really expect that to change the course of market direction this year. And so like some of the Trump policies that might be more problematic, we kind of have a base case that we think they'll be more of a headache than really disrupt the cycle. To give you just sort of a quick recap of our positioning, we have a couple slides here just on the sort of, by all the various asset classes. This is published on our website at UOB Asset Management. You can refer to this later. But quickly, we're overweight equities. We're kind of more neutralish fixed income. We would be like, we think investment grade credits and high yield credits are attractive, but would be underweight things like government bonds. So overall, kind of more sort of underweight to neutral fixed income. And then we're kind of more neutral on the sort of alternatives like commodities and real estate right now. And we would be underweight cash. We don't think deposit rates are that attractive now, especially compared to the yields you can get elsewhere. We also do various breakdowns and where in the world we're investing. Oh, sorry, on this other page, we do have the U.S. as our main overweight. Last year we had both the U.S. and Asia as our main overweights, but as we start the year, and especially for the first quarter, we reduced Asia to more of a neutral to give some time to process, I guess, trade wars that might be coming. But for the most part, I think in today's conversation, we're going to highlight that we actually have a lot of positive views about Asia, but we're trying to be nimble to the various factors that may be occurring in the first quarter. As I mentioned in fixed income, we have a bias towards credits, more cautious on the government bonds, and within commodities, we're kind of more neutral most commodities, but we've been long overweight gold, and we still remain overweight gold. So I think that's sort of summary of our main positions. I have longer presentations that we give. I think I kind of wanted to mostly give this as just a summary, but just to highlight some of the key points we usually highlight that. So firstly, not only do we see positive GDP growth around the world, but we usually highlight, we don't invest in economies, we invest in companies. And as we look at companies around the world, earnings growth has been and remains really attractive. We're pretty much seeing double-digit earnings growth in all the major regions we're investing. And we think that continues on into the next year. And, I think a lot of this should involve a bottom-up story on what are the exciting trends that are going on. And, I'm more of a macro guy, but I would say, I listen into our teams talk about the bottom up stories that are going on around the world, and quite honestly, there's just a lot of them. Whether it's tech in the U.S. or the biotech or the EVs, there's just a lot of innovation going out there, and I think in a world that has positive growth, investors out there should be looking at all this and trying to find who are going to be the winners. The other key element that could disrupt a macro trend would be inflation. And so we do think, there's a very clear trend around the world that inflation has been coming down after the pandemic. And I do think that's sort of a general force that will have still some legs in the coming year. But as Jinye mentioned, there's things that we're watching that we do think this is slowing down, that those benefits from being post the pandemic, those look like they're slowing. And then some of the policies in the US might sort of push things up again. And as Jinye mentioned, we've published a higher for longer white paper in where we see the case that inflation is going to be more challenging over the next decade than it was the prior decade. But that still overall, I would say, leaves us in a view that we don't see inflation as being the type of problem that should destabilize markets, but it's not going to be a slam dunk where everything is just purely disinflationary. We do our various forecasts on, especially the U.S. inflation, given potential tariffs. And so, our base case as we model this out, just to give you some quick numbers, is without tariffs, when we look at the various components and the trends that we're seeing underlying, we would have argued you get a little bit more improvement in 2025, and you probably get inflation down to around 2.4. But with the expectations of tariffs that we're building in, we're actually get that more to around 2.7, which is pretty much about where it is now and is kind of more of a flat line rather than a continued improvement. But there is a risk that tariffs become much more aggressive. And if so, then you could have an uptick in inflation again. And that kind of remains one of the uncertainties. But I would have all of these as not necessarily being disruptive to markets, more of just a potential headache to markets. How about let me quickly give you just our rate views. And so, this table's a little bit complicated, but when people talk about their expectation for bond yields, I hear from clients many times it feels like strategists are just picking numbers out of a hat. But really, our approach, and I really think the way most of the market is doing this right now, is they're looking at given like a Taylor rule model that the U.S. Fed follows, and given the key inputs around what we're getting for inflation and unemployment, what does this imply that the Fed will be thinking the Fed funds rate should be? And I guess as a quick summary, depending on the various ranges you might get, I'd say on the low end, you could get a Fed funds of around 3.6, and the high end, maybe like a 4.7. This is the sort of the blue box, which is a little bit of our base case. And, so our base case is that we think the Fed funds should go down to 4% this year. And then from there, you should actually be able to build a very sort of clear view of what the slope of the yield curve should be. And therefore, you can create a range for your other bond yields. And so, therefore, if the Fed funds is 4, an upward sloping yield curve would put the 10-year between 4.25 and 4.75, which is our view. And therefore, that's a level that's certainly not low, but does provide attractive yields to fixed income and doesn't necessarily have to be so problematic that we have to be scared of investing in fixed income or scared that it's going to destabilize other markets. What we have to watch is maybe these inflation numbers surprise us, and that's always a risk. But I showed that chart really for 2.5 years now. We've kind of had a downtrend, and it'd be a bit shocking now to see a spike. And also on unemployment, it is possible maybe it rises or lowers faster than expected. So I think those are some of our main points. And then back just to our higher for longer concept, we just went through a decade where both yields and inflation was really low. And we think it's going to be structurally higher than that. But I think a lot of people, when they talk about higher for longer, I don't know, seem to have like hints of the 1970s. And that's not what really we're referring to. We're expecting something more like what we had in the 90s, which is, the Fed funds and bond yields kind of similar to what we have now. We've had periods of rate cuts in the middle of that cycle, like we're getting now. And it does mean, your yields are higher, but it doesn't necessarily mean that you have to be overly scared of investing. And I would say that, when it comes to equities, boy, this period feels a lot like the 90s. This period of AI excitement and technology excitement does feel very reminiscent of how investing felt in the late 90s as well. And I think there's a lot of parallels. And therefore, when we think of higher for longer, I don't think we have to be overly negative. I just think, it's sort of like a two-sided risk that we have to watch. So I was going to leave it at that. I think we could, in our conversations, go through more about valuations and Trump policies. But I think my introduction was only meant to sort of keep it as a brief overview to lead into the conversations the rest of us are going to have. I would just say quickly that when it comes to the tariffs, we do expect some, but for the most part, we think that their goals will be to get deals. And that when it comes to valuations, our overall view is that they're high. But really, once you take out a lot of the mega cap tech stocks, that the rest of the market is just only a little bit high. And that when you look at those large tech stocks, their valuations can be justified. Their earnings are so strong and the growth is so solid and the prospects are so good. While the valuations are high, they aren't necessarily wrong. And therefore, we don't necessarily see a big correction in the markets. And hence, as I mentioned, we have a solid base case outlook for the economy. We think equities can continue to perform into this. And for fixed income, we have good yields now. And as if we don't have any type of correction, then credits should be able to continue to give good solid returns. Okay, I'll stop there then and turn it back to our next speaker.
Hey, thanks, Tony. So we're going to move to a panel discussion now, and I'm going to get Jin, which is our CIO for UOB Asset Management. Tony's going to stay online. Tony is basically, just for everybody's knowledge, Tony's our head of multi-asset strategy. I'm going to invite Philip. Philip is the MD and investment director for equity strategy at Wellington. And just before we start this conversation, I just want to remind you that you can put your questions as we go along, and we can answer it at the end of the session. Just put it in the box at the cycle there. So we're going to talk a little bit about the prospects of Asian markets. So let me just start with Tony. Okay, Tony, we talked about a relatively exciting window. We've covered a little bit about Asian specifically in our first half, and maybe a bit more optimistic on the second half. Do you see this as a long-term story? Where do you see this growth in Asia, and what do you think will be the key drivers, and not just beyond 2025, 2026, 2027, and beyond that? What's your thoughts on that? Yep.
Okay, thanks, Shankar. Yeah, so as a starting point, I mean, we like the outlook for Asia growth this year. We think economic growth is supported on multiple fronts. Firstly, we still have the U.S. consumer. The U.S. consumer is a really dependable base that we continue to rely on. And then additionally, we've had these China stabilization policies, and I think there's various market opinions on these policies, but for the most part, we take it as not necessarily being overly stimulative, but does provide a base, makes things more stable, and I think makes the overall economic outlook in Asia just all the more stable for the coming year. Additionally, we have interest rate cuts. Historically, that has been very good for Asia. And then I would say, like more on a bottom-up basis, I think we like the sort of domestic market trends that we're getting in places like Southeast Asia. And then we just like all the innovation that we're seeing in places like Taiwan and also China. There's a lot of stories of innovation and manufacturing success in China that we could go into. But that creates a stable base of growth. And then the other things, I think your question was also asking on a multi-year outlook. And I would say the other parts that, I'm a little bit biased towards keeping an eye on Asia because it's underperformed for the last decade, and its valuations are better. And, I think these sort of regional trends sort of go in cycles. And after over a decade of the US outperforming, I wouldn't be surprised if, Asia eventually has its turn again. And I think a lot of what Asia is doing is not getting appreciated, right? China is so beaten up, but their innovations are just spectacular. Everything, especially around those the green energy trends, the EVs. You would know, Shankar. We were just discussing it yesterday morning. The Xiaomi SU7. God, what an amazing car they're producing, right? This is a handphone company, and now they're creating a Porsche lookalike that's faster, gets 800 kilometers on its battery, and sells for 29,000. I'm just like, wow. I mean, there's just a lot of exciting things going on, and I think it's getting underappreciated, and hence I think there's a lot of to pin the growth outlook on.
Hey, thanks, Tony. That's really, really exciting. So I want to move to Jin. We talk about Asia, we always think about equities. We don't think so much about fixed income, and I think it's become something a lot more interesting, a lot more attractive. And Jin, you come from a fixed income background. Maybe can you share us a little bit of your thoughts on the fixed income outlook, especially in Asia? Where do you think things are exciting? Where are the opportunities? And we love to hear that from you. Yeah.
Yes, I think the answer to your question, Shankar, is yes. I think Asia fixed income will be an important asset class in 2025. If you look at the average yield for Asia investment grade, it is still hovering at historic highs, even though the spread has tightened to about just above 100 basis points. But if you look at the total yield then it's currently at about 5.25. If you look back the history, last 10, 15 years, it is still a very attractive level for investor. That's why we continue to recommend Asia fixed income for a lot of our clients in 2025. And then moving on, even if you are willing, or able to take a bit more risk, the Asia high yield still offer a lot of spread buffer. If we look at the current spread towards Asia high yield is hovering around 520 basis point, which is just around the average since 2005. So there's still more room for spread to tighten on the high yield in the high yield space, and as a result, your total return will be even higher in 2025. So I think in short, I think as the two slides shows, there are reasons why we still like Asia fixed income. In fact, our expected return for Asia IG in 2025 is probably around 5%, and then with very little interest rate cut by Fed in our expectation. And then high yield, you probably get around 8.5% expected return for 2025. So that is still very attractive return for any portfolio allocations to include Asia fixed income. I hope I answer your question, Tony. Shankar.
Thanks, Jin Ye. I think it's really exciting, and I think it's an asset class that's exciting as rates drop, as banks' deposit rates drop, and I think this is a very interesting place where clients can actually start putting their money to work. Speaking about clients, and Philip, we've traveled quite extensively together over the last few years, and one thing about Asia is that we've got a very interesting base of investors. We've got young, up and coming. You've got the highest growth of wealth over the last few years, and we come to talk about Asian investors because I want to talk it from a different perspective. How can Asian investors start diversifying their equity holdings? They're very, very different from European investor. They're very, very different from American investors. And maybe if you can share with us a little bit in terms of what kind of strategies provides a good complement to our client portfolios, especially given that, okay, we've got opportunities on the upside, but you've also got challenging geopolitical risks. You've got inflationary backdrop. What's your thoughts on this?
Yeah, absolutely. Thank you very much, and good morning, everyone. So maybe I'll just start by saying that certainly our views at Wellington really rhyme very strongly with the views that Jin Ye and Tony have shared today. And in particular, in my role, focusing on Wellington's equity strategies, Tony, your comment about the period in the late 1990s, where equity market performance was very strong, there was a lot of innovation and progress, particularly in tech. That absolutely does resonate with the market environment that we're in today. And indeed, I would add to that one key area of difference that it's actually better today than in that late 1990s period is when you look at company level fundamentals and company level earnings, they're actually far more robust today in the tech sector than they were back in 1995. 1995 through 2000, there was a great deal of hope and excitement, but relatively low profits in many, many cases. Versus today, the profits of those companies are strong. But I would also say that that's to some degree reflected already in their valuations. So yes, the Magnificent Seven, just as one subset of these highly performing companies, yes, they've done very, very well, but their valuations are also reflecting those very strong performances. And we know that what goes up can also potentially come down. Now, also to make a point that Tony commented on earlier, we don't see a likelihood of a prolonged and very deep period of underperformance in these names, but absolutely we can see periods where there will be sell-offs and weakness, at least for short periods of time, in those tech-driven businesses. So while, as Tony has shared, we continue to be optimistic on US equities and the outlook for tech-driven companies, we also think that there's a really important opportunity to start to add hedges to your portfolio, to start to add exposure to companies that are more defensive in their return profile. Because given valuations, particularly in the US, there will likely be some periods, at least in the short term, of weakness in those stocks this year. So great to have an element of your portfolio that can provide a defensive hedge when those businesses, at least in the short term, stumble. So let me try and share my screen just briefly to highlight this in a slide. So what this page shows is the importance of having exposure to companies that are more defensive than the market, companies that fall less than the market during periods where markets are weak. And in particular, I'd highlight here the chart on the left-hand side. The blue bar at the top of the page shows the sort of stylized returns, but of a portfolio that is defensive in nature. Now, what I mean by that is when the market is rallying, when the market is up strongly, this is a portfolio that lags. It's up, but it's not up as much as the market. But where this portfolio shines is when markets are weaker, the portfolio doesn't underperform as much as the market does. It's more defensive in nature. Now here, this portfolio over a long period of time, you can see the size of the blue bar compared to the market, the S&P 500 in orange, just by falling less in short periods where the market declines. This is a strategy that outperforms the market very meaningfully over time. And the reason for that is because the portfolio is more defensive, because it falls less when the market is declining, you've got more money to benefit from the upside in markets when markets rally again. And this type of strategy, particularly in the environment that we see this year, where overall the outlook for the economy is pretty good across the world, the outlook for equity markets is pretty good across the world, but we could see these pockets of volatility. Losing less during those pockets of volatility gives you more money at work when the markets then rally afterwards. And again, over time, this is the type of strategy that can generate very strong returns for clients. So that's one area where we would suggest that, particularly for Asian clients, where we tend to have more kind of pro-risk exposures in equity portfolios, a defensive exposure could add a nice hedge to portfolios for clients.
Thanks, Philip. That's really, really interesting. And I think that's something that we see a lot of clients talk about. I'm going to move into the three I's, okay? I'm going to talk about isolation, inflation, and income. And Philip, maybe let me start with you. And let's talk a little bit about isolationism. And we're talking about the what's happening in US. There's a lot of conversations about tariffs. And I'm going to ask you this in terms of three questions. First and foremost, what's your views in terms of the US tariffs? Are they going to be better? Are they going to be worse than expected? Given that it is Trump 2.0, there is a little bit more of an experience dealing with it. In Asia, there are two questions here. How would companies respond? And critically, what can an Asian investor do, given that, look, this is really beyond my control? How do I take on this? Maybe is it an opportunity? Is it a risk? How do I manage that?
Yeah, absolutely. So I guess the first thing to acknowledge is that, unfortunately, nobody really knows with certainty how Trump will proceed. But definitely, just to the point of your question, Shankar, there are potential risks. So, for example, tariff policy is something that Trump could implement as president. So, and he becomes president on the 20th of this month. He could implement those policies in full on day one, meaning up to 60% of tariffs on Chinese goods and 20% and 10% in some cases for every other country around the world. So worst case, 21st of January, we're in a new world of really significant trade protectionism. These are not laws that need to go through the houses of Congress in the US. Trump can do them directly himself day one. Now, that said, that's the worst case scenario, and we don't think that that's likely. But equally, it's not likely at all that there will be no tariff barriers introduced, because that would essentially lead to Trump, losing face and losing credibility. So somewhere in the middle of no tariff changes to up to 60% on China is the likely outcome. Now, the interesting thing about this, and despite Trump's rhetoric, yes, inflation is likely to rise as a result of tariffs. Tariff policy, trade barriers, they're inherently inflationary in nature. But Trump says that inflation, that cost, would be borne by the US's trading partners. That's not true. At the end of the day, it is US businesses and US customers who will bear the brunt of those tariffs. That's the reality. And therefore, the related risk is potentially that US inflation, and Junior touched on this earlier, and as did Tony, I think, might be higher than the market is currently pricing in. That's one risk scenario to bear in mind. So, what can clients do about this as well as what can companies do about this? Well, the first thing to bear in mind is while a lot of Trump policies are targeted or focused on China, in reality, China is not a very strongly trade-driven economy. Now, I'll bring up a slide to show on that point. So if you look at the right-hand side of the screen here, the bar chart there, China is the third bar in from the right-hand side of the chart. This looks at trade as a percentage of GDP for a bunch of different countries. China is not a very trade-driven economy. It's a very, very large economy and it trades a lot, but trade as a percentage of the economy is pretty low. If you look in contrast at the left-hand side of the page, Europe, the EU there, is a lot more trade dependent than Asia or China are. And so thinking about these as risks and linking into Tony's comments earlier about the optimism for Asia, particularly in the second half of this year, actually, Asia ex-Japan as a region is relatively well insulated from potential risks from Trump's trade policies. So making sure you have exposure to Asian equity in your portfolios is actually a great hedge against the potential concern of these tariffs. Now, in terms of what companies can do, there are a couple of things. So the first is maybe specifically starting with China. Chinese companies don't need to do much. If you look at the listed stock market in China, only 10% of company earnings come from the US. So actually, there's not much exposure there. There's a whole lot of talk, a whole lot of politics, but relatively little risk in reality at the stock level. So they wouldn't need to do much. But many other countries around the region, so countries like Taiwan, for example, do have a great deal of exposure to US demand. And one thing that companies can do, and the same would go for, say, Korean car makers like Hyundai, what these companies can do is establish manufacturing operations in the US. Now, funnily enough, TSMC is already doing that from Taiwan. Hyundai is already doing that from Korea. But there are concrete actions that companies can take by making products in the US to sell to US consumers that would minimize the impact of tariffs on their companies. And when we looked at, Tony commented on this earlier, at UOBAM, the investment approach is focused on the stock level, picking companies with good fundamentals. That's the same at Wellington. So we can use these understanding of fundamental drivers to identify companies that are more insulated from the potential risk of tariffs.
Thanks, Philip, and that's really, really interesting. So what we take from this is that it's a lot more nuanced. It's not just a broad base and look, everything goes on to that. And that comes very interesting in terms of a conversation for inflation. So Tony, I think we're looking at potential, and the markets are pricing a certain amount of less rate cuts. 10-year rates have gone up a little bit more. But what about Asia? Everybody talks about this as being the US dollar curve. So Tony, what's your inflation outlook in Asia? Is it going to be less of a problem in Asia than in the US? And how can investors react to this, Tony? Yeah.
Okay. Yeah, good question. So I do have an interesting perspective here. Through my whole career, I've been working in Asia since the 90s. Throughout my whole career, I've always been concerned about inflation in Asia and emerging markets in general, and not so worried about inflation in developed markets. And it's kind of odd right now, but it's somewhat reversed. I'm a bit worried about inflation in the US, and I'm not so worried about inflation in Asia. And historically, it's like the logic is, as emerging markets and countries in Asia have been growing, their sort of speed limit and how fast they could get to sort of more developed market status is the fact is how much can you build without making things too inflationary. And inflation was always a borderline risk for these Asian economies over the years. But as we are right now, the fact is they're not growing too fast for their ability to grow. And of course, you have countries like China that are almost somewhat disinflationary. So for the most part, we don't add up and see very significant inflationary concerns, especially by historic levels throughout Asia. And if anything, our focus is more on developed markets, particularly the U.S., maybe Japan, but primarily the U.S. right now. So I think that creates a little bit more comfort for the economic growth in the region, interest rates in the region, and fixed income investing in the region.
Thanks, Tony. That's really interesting. So we've talked about isolation, we talked about inflation, and I think one thing that we've seen a lot of conversations maybe in the last 6 to 12 months has been on income. So Ginny, we talk a little bit, we touch a little bit about fixed income. Uh, I feel that plays a very important role within the income space. Naturally, there's a very attractive dividend. So Ginny, which part of the Asian fixed income sectors do you favor, and where do you think our customers should start looking for opportunities?
Thanks, Shankar, for the question. If you look back, Asian credit has actually done pretty well in 2024. We look at the square box on the right-hand side. The high yield has actually returned 15.2%. And even the Jackie investment grade is 4.2%. And in fact, we expect this outperformance, especially for Asia credit high yield, to continue into 2025. And one of the reasons why is that if you monitor the default rate, I think we all are probably very familiar with the Chinese property, distress, and a lot of bankruptcies that have been going on for the last 2-3 years. It has actually backed down. In fact, we are expecting into 2025, level that is back to the pre-COVID level. And I think with that, we think Asia high yield is probably one that we like the most. And in fact, I think one has to be more selective. We have avoided a lot of this Chinese property default and all those. But other sectors in the Asia high yield still offering very good, attractive return. In fact, I want to stress that it's real return that provide excess return above your sticky inflation that we have been talking about. Maybe 2.5 or 3% kind of inflation level in US, and maybe also slightly lower in some part of Asia. And we also think that a lot of the Asian central banks are in good position to maybe cut some interest rate along the way, as Fed also reducing interest rate. I think with that backdrop, Asia fixed income is going to be a place where you can generate real income for your portfolio.
Thanks, Ginny. So let me move to equities a little bit, and maybe Philip, this question is for you. So Asia's always been seen as an opportunity for growth style, returns. Is there a scope for more defensive, more dividend kind of focused portfolios, especially for Asian investors?
Yeah, so Shankar, there absolutely is. And just as you said, I think for many investors, we see Asia as a high GDP growth region, a region where companies can grow their businesses and grow their market share. And in many cases, as a result, they're reinvesting their revenues back into their own businesses to try to grow revenues. And dividend yields tend to be relatively low in those cases as a result. But what I think is misunderstood by many in the market, and I'm bringing up the chart here, is actually high dividend companies over time. So not necessarily high growth, but high capital return to shareholders. Those companies have actually really significantly outperformed the wider market in Asia. And so if you look at the light blue line, that's the high dividend, high income companies in Asia, their performance. And then the rest of the Asian region, the regular benchmark, Asia ex-Japan in green, you can see significant outperformance. But even more interestingly, I think, is if you look at that dark blue line, that's the S&P 500. So the total return of high dividend companies in Asia ex-Japan has actually meaningfully outperformed even the US market. And we know, Tony commented on this earlier, looking across the world over the last decade or more, the US has been by far the best performing region. But despite that, high income companies in Asia have delivered a better return again. So, absolutely, this is an area of opportunity that we think is really interesting this year and indeed for many years to come.
Thanks, Philip. So just before we go into the Q&A, and I remind everybody, if you've any questions, please pop it up. Tony, if you were to take everything together and you sum it up, if you look at a client that sits in the middle, a balanced investor, what would a multi-asset portfolio look like going into 2025?
Okay, I think I would have it actually pretty similar to our global portfolio, where we would be overweight equities, but still like a lot of the opportunities we're seeing in fixed income, and so therefore it wouldn't be like extreme positioning, but and I would also highlight that I actually think this is kind of similar to what we saw in 2024. I think it was somewhat underappreciated, but we had Asia fixed income as being a clear outperformer versus global fixed income benchmarks. And in 2024, while the US equities were the top performer, for Asia really came in second of the major regions. It outperformed Europe and Japan and so forth. So I kind of think that we can sort of see a similar trajectory where we can count on Asian equities probably to come a bit higher, but Asia fixed income being a nice stable yield base to count on.
Thanks, everybody. So let's move into the Q&A session. I have a couple of questions, and then let me try to address this by an asset class so that we get an interesting flow. And I think it's a good place to start. Okay, one of the main questions is that we've seen the US stock markets continue to go up in 2025. What's the views in these markets? And is there a specific sector? Is there specific themes that we start looking at in those markets? Maybe I can get Philip to answer this question.
Yeah, sure. So, as I mentioned earlier, we continue to be optimistic on the outlook for the US market this year, but we note that US valuations are also pretty high, much higher than anywhere else, and so reflective of those good fundamentals. So there's a lot that's priced in. Now, we've started this year on a positive note for the US. Indeed, we think it's relatively likely that that will continue at least over the next couple of months. But we do think that, after the 20th of January and into Feb, into March, as we start to see, Trump in the White House, policies perhaps starting to be enacted, that there could be some risk scenarios for the US. Again, we're talking about shorter term sell-offs, not a long-term meaningful underperformance of the US. But that's something to bear in mind, is it may well be a year with a little bit greater volatility. One of the opportunities, we're already starting to see this in recent earnings results, but I think one of the opportunities for this year is the last 2 years in the US were dominated by a very small handful of companies. What we're starting to see is the S&P 500, excluding the Mag 7, earnings are improving on a relative basis. And Mag 7 earnings are still really good. They're still better than the rest of the market, but they're gradually starting to come down a little bit from the highs of the last 2 years. So we might see a widening of breadth in the market in the US. And that to us is a really interesting opportunity for this year going forward, is maybe it won't all be about these Mag 7 stocks. There's the opportunity for the rest of the market, and indeed, as we've been discussing, for non-US markets to do a bit better this year.
Thanks, Philip. So there's another question in terms of equity markets, and maybe Tony, you can help to cover this a little bit. For 2025, what is the forecast for Asian equity returns, especially compared to US, Europe, and maybe even Japan here?
Okay. So, 1 year returns are always really hard, but let me go ahead and throw out the numbers we've been sort of talking internally. So, we kind of have the US as our top performer. We're expecting sort of like we're calling it like a 9 to 12% type expectation for US equities. And so for Asia, we have a little bit under that, but we still think it can be sort of like a 7 to 10 type range. So we have that. I would call that a good performance. But we had the U.S. as the outperformer. And I guess the other perspective is when we were trying to figure this out, we were thinking probably there's headwinds around all the noise around tariffs at the start of the year, but by the end of the year, we think the earnings and the economic trajectories there, that those types of returns should come through.
So there's a couple of questions in terms specifically about Asian equities and unsurprisingly specifically on China. And there are two questions here, and maybe Jinia, you can help to key in some answers. First and foremost is that from a China point of view, there are two concerns about. First is that there's a push for a lot more tourism for domestic consumption. Would Asian countries benefit or be impacted by this? And the second is that in terms of the China EV industry, given it is consolidation, even there's oversupply, would there be long-term concerns in those markets? Yeah.
Well, if I may just verbally answer this question briefly. I think the focus for Chinese equity markets, our in-house view is to be defensive and to be domestic focused. So I think we'll be less on export oriented, kind of industry because of the policy uncertainty, and also those sectors that depend on Chinese tourist spending overseas. And EV, I think, keep it very short. There will be consolidation. Keep it to the largest player in that segment of the market. And similarly, like what we like Chinese property now, we only keep it to the very good quality state, backed by the state government kind of property counter, but not the rest of the private property companies.
Tony, there's a very interesting question, and I'll expand this a little bit more. So there's a question about how the SG equity markets will perform this year. Maybe let me expand this a little bit more. What about Singapore and the ASEAN markets, given that that's a little bit more home ground for us? We talked about Asia in general, but what's your thought on ASEAN and Singapore and ASEAN? Yeah.
Okay, yeah. So for ASEAN, what we think is we have a good, stable domestic economic growth going on. We like that as a base. We think this region has been sensitive to U.S. rates historically, where when U.S. rates are going up, ASEAN usually underperforms, and we're getting rate cuts. ASEAN usually can outperform. And I think, we're in a world where we've already gotten rate cuts and we think we're going to get more in 2025. I think that creates a good backdrop. We like valuations. We've been looking at Malaysia and we're like, I think those valuations look attractive. In Singapore, the lower rates help key sectors like property and banks. And so anyway, for the most part, we like what we're seeing in both Singapore and ASEAN.
Thanks, Tony. So let me move a little bit into fixed income, and there's an interesting question, okay, and I'll expand this a little bit more. So the question asks how do you reconcile rate cuts with good bond yields? And maybe I ask this to 2%. So Philip, how does rate cuts and reduce rate cut expectations impact the equity markets? And maybe Jinye, how does this reduce how does rate cuts actually translate to attractive yields in the market? Maybe I'll start with Philip first, yeah.
Yeah, sure. So, as we've been discussing earlier, and Tony just mentioned, the market expectation, ours at Wellington too, is that we will see probably 2 rate cuts in the US this year and various rate cuts in Europe and other markets, not so Japan. And that typically is supportive for risk assets. So it aids in a positive outlook for equity markets this year. The one, I guess, nuance there, though, and we've touched on this earlier, is what happens with Trump and trade policy and what's the impact that might have on inflation. It would be more inflationary for the US market than for non-US markets. And, again, worst case scenario, if tariff policy is enacted rapidly and at very high levels, then maybe we don't see any reduction in inflation in the US this year. And maybe as a result, we don't see any reduction in rates in the US this year. That's not our base case scenario, but it is a risk to think about. And if that were to happen, well, equity markets aren't pricing in no rate cuts in the US this year. Equity markets are pricing in 2. And so then that might be a risky scenario for US markets, given that valuations are higher. So again, not a base case, but it's something to bear in mind. And we'll know more 20th of January onwards when Trump is in the White House.
Yep.
Thanks. Well, if you look at the fixed income space, I think the lesser rate cut by Fed is kind of already discounted. Why we like high yield? Because that provides a bit more buffer against potentially, let's say, inflation surprise on the upside and Fed is not cutting at all. But because of the spread buffer that you have for high yield, that's more than sufficient to buffer that and give you a very attractive total return of 8% or 8.5%, or even even if market were to correct 7.5%, kind of region. So that still make the fixed income attractive. And then just to remind everyone, we are of the scenario not going back to the last 10 years where inflation are low, interest rate are at zero level. We are back to the mid 90s, so you still get overall the total yield of 5% even for investment grade. Yeah.
So I've got a couple more questions, but in mindful of time, let me just I think there's one attractive thing, and maybe Tony, I can maybe get your help on this a little bit more. So given the outlook on Asian fixed income, how much of your portfolio should be in Asian fixed income for an investor from a percentage point of view, and maybe even from a returns point of view?
Okay, so that is kind of a question that goes client by client, right? You'll have conservative clients that should be 70% fixed income and more aggressive. But let me give this comment. So, as you know, we give recommendations. We think a lot about these long-term historic returns, or what expected in the future. And so one thing I would highlight as an attraction of fixed income is when we look at like the coming 10 years, we're getting like average returns for fixed income that are a good solid 4 to 5% at least. Whereas for equities, we are getting lower long-term returns because valuations are higher. And therefore, we're only getting numbers like 7% type of long-term returns in equities. When you think of that, you think, oh, why am I dealing with all these headaches of equities where they can be so volatile in 1 year? Why not take my 5% in fixed income? And therefore, I guess my message would be to any client who has a conservative bias. I would say, when yields are like they are now, you shouldn't feel like you're missing out that much. You can get good, solid returns, and you should be comfortable going with that.
Okay, we've got a couple more questions, and I think we've got to address it after this session. I want to thank the panelists today. It's really, really exciting session, quite exciting for 2025. A lot of opportunities, a lot more nuanced points of views. And I'm going to get Jinye to wrap things up, give our overall views, and then on this. Yep, Jinye, to you.
Okay, thanks, Shankar. Well, I think the 5 key investment takeaway. First, to overweight equities. We still like equities. It's not a recession that we're talking about in 2025. But of course, be defensively positioned, domestic focus in some of the countries, due to some of these policy uncertainties. Take a multi-asset approach, holding some fixed income or even gold to hedge against any growth downturns and geopolitical conflicts. It's one area that we are watching very closely. What are the Trump's policy that may even increase geopolitical risk? Consider Asia fixed income. I've talked a lot about Asia fixed income. High yield provide good buffer in terms of spread and opportunity for both yield and capital growth. Aim for real return, higher for longer inflationary environment, require investor to achieve real returns. I think Philip also talked about dividend-driven kind of equities, quality company with good dividend. Why not? That give you that real return in addition to your fixed income that give you a 5% to even up to 8% with relatively stable kind of asset classes. And whole US dollar, we like US dollar in the first half 2025, or US dollar pegged currency are set to remain firm and strong. I think with that, I turn it back to Shankar.
Okay, everybody. I think we've come to the end of the conversation today. We hope that this gives you a little bit of a guide in terms of investments in 2025. I want to thank Jinye, Tony, Philip, and I think it's been a really interesting session. I want to thank all the people who dialed in today morning from all across the regions in Asia. And this is our details here. If you need to contact us and you need any additional information, some of the questions that came in, we couldn't address it. Please reach out to your contacts. You can go on to our social media page. We will be posting snippets of this to continue these conversations, and I can guarantee you we will have more conversations throughout this year. I wish you again a happy new year. All the best in your investments, and we're very excited about 2025. Thank you, everybody. Have a good year ahead.